Hey, Mike here, and yes, we're doing a spring opening of the Wall Street Window Power Investor service. This is my private market mastermind group, and we'll be closing that out Thursday night at 10 o'clock Eastern Standard Time. Now, what I want to talk to you about today is the new Micheal Lewis book, Flash Crash, which just came out a few days ago, and it's about stock market manipulation, and at the moment, it's the #1 best-selling book on Amazon.com, and it was all the talk everywhere on the internet and on television yesterday. In fact, I saw half a dozen segments on CNBC myself about this, and most of the segments were about defending the stock exchanges from the charges of manipulation. And I want to really talk to you about this because I really do think that there is manipulation, and the market is different than when it was when I first started out in the stock market way back in the 90s. Back then, all this high-frequency trading wasn't a big deal. But what we witnessed yesterday on CNBC were talking heads defending the market against charges of manipulation. And I think that there's a fear among people on Wall Street and these television producers that if people think that the market is manipulated, that they'll just give up. They won't watch the television anymore. They won't believe in the stock market. And they see that as harmful for their interest. And I think I want to tell you that I think they see themselves as doing a service to the people by arguing against this stuff. And I kind of understand where they're coming from in a way, because worrying about stock market manipulation can make it very difficult to be successful in the financial markets. But you do have to recognize reality too. You can't deny reality either. But typically what I've found over the years is that someone who talks about manipulation a lot is usually someone that's lost a lot of money in the financial market, whatever market they're in, and they're using that as an explanation for their losses instead of taking responsibility for it, for the real reasons, which are, well, either one or two things all the time. It's either they have lacked the knowledge to invest properly and handle their money in a prudent manner, or they just emotionally couldn't do things correct. But if instead of taking responsibility, they blame manipulation for their losses. We've seen that a lot in the gold market. Because look, gold has fallen since 2011 to last year in a vicious bear market. And a lot of people, instead of saying, hey, this is a bear market and it fell, I was in it and I lost, they want to say, well, you know, gold should have gone up and it's manipulation that made me lose money. No, you know, you lost money because you doubted that it was a bear market and you refused to adjust yourself. And now we're kind of in an opposite situation where I believe gold is in the opposite where it was in 2011 when it rolled over. Now it's rolling up. And still, you know, instead of acting on that, what's on the charts, people don't want to do that. And they're just saying, oh, it's manipulated, so I don't have to be responsible for my decisions. So in that sense, fighting against the belief system that the market's manipulated, which I see a lot of these people in CNBC doing, in a way that is kind of helpful to people, but because I think that's what they're trying to do. And like I'm saying, people who worry about manipulation are almost always stock market losers. It's virtually impossible to make money in the stock market, any financial market, from a position of total fear, which is generally when people speak of manipulation, that's the language they're speaking in. And that's just the way it is. I mean, that may sound like a tough thing. I know that's going to make a lot of people upset me saying that, but that's what it is. I'm telling you, man, the language of manipulation, when it's being used by someone who's lost money as someone using it as an excuse. And if you can only make money in the markets by taking responsibility for your decisions. But then on the other hand, it is a reality that there is manipulation. What you've got to figure out is how do you deal with that? Not say, oh, it's manipulated, I'm going to give up. But say to yourself, okay, if it is manipulated, how's that impacting the financial markets, and what do I need to do about it? And that's what people should be talking about, and that's completely missing right now in the conversation, and why I need to do this video for you. So I want to point out something to you. Here's a story today. And these stories are, this is the story of the moment, right? Micheal Lewis puts the spotlight on frequency traders. The U.S. stock market is rigged because these traders are in there scalping pennies from everybody, right? So how can you beat these computer programs that are doing this? And here's something that I've read this article, and I'm going to buy the book and read it myself. I read his other books, and they're fun. They're great books. But here's something that catches my attention. High-frequency traders account for about half of the volume in the U.S., a statistic that shows the pervasiveness and hits at the obstacles faced by proposals to rein them in. The exchanges rely on these trades for profits. The bulk of the profits now going to the New York Stock Exchange, the NASDAQ, and these other exchanges in the United States are coming from these high-frequency trading robots. And if you're going to get in this game and try to do short-term trading, you've got to fight these robots. And, that's tough to do. And that's what I want to show you, why that's tough to do. And I think that actually this statistic is understated. I think it's responsible for much more than half of the volume. Let me show you. This is from this chart's from 2005, but this is showing you the percentage of trades going to the New York Stock Exchange that were from program trading. In program trading are one or two things. It's orders done by these trading robots, or it's an order of a huge share position from a giant institutional trader that's given to a robot, and multiple small trades are done in order to build the position or sell the position. So they're not day trading, but they're using the techniques of the trading robots to try to get in and build a position over a day that's gigantic, to try to get the best price. But this is the thing I want to tell you, is when I first got into the market in the 90s, the trading robots were not in the news. Program trading itself wasn't a very big deal. In fact, the statistics show that back then it was 20% of the volume. And by 2005, it had become 70% of the volume. And I know this chart's from 2005, but before I did this video, I did some research, and there have been months in the past couple of years in which the percentage of the trades going to the New York Stock Exchange that were program trades were over 90%. Now, there's two things about this that are troubling from the standpoint of me or you or any other so-called small player in the market. And man, even if you got $1 million, you are a small player compared to a trading robot doing billions and billions of dollars in transactions a year. And yes, there are some hedge funds in Greenwich, Connecticut, that's all they're doing. But a dirty secret is that over the past couple years, fewer and fewer of the funds are actually turning a profit, and many of them are going out of business. What has happened is there's been an arms race for the most advanced trading robots, and some of the, obviously a lot are falling to the wayside, and they're having to change the programs every month and fight each other. So, you know, it's what it is. And but from our standpoint, the two real troubling things about it is market risk. When all these robots lean in one direction or the other, that creates unusual market volatility in the stock market, and was a big responsibility for the so-called flash crash, which occurred a couple years ago. That's the day in which the Dow fell around 1,000 points, slightly over 1,000 points, during the day in July, I think it was 2011, and then turned around. What happened was, on the chart, the Dow fell below the 200-day moving average, and that sparked a massive influx of program trades to sell, which sparked a mini crash. And then by the end of the day, the selling was done and things came back up. Of course, that raises the specter of a 1987 style event, a true market crash. What if things hadn't turned around before that day was over? Who knows what the stock market would have done? Because who knows what these trading robots would have decided to do the next day? So yes, that is a real risk for all of us that are in the stock market. But I say that because I want to use this video. The purpose of this video is to help you manage this and not be ruined or taken over by fears of manipulation and trading robots. In fact, I believe we can sidestep the whole issue and not be a victim of these things, but be a winner. And I've done it, and there's no reason you can't do it yourself. So that's the first risk, the risk of a market crash. We'll keep that number one in mind. Risk number two, or trouble number two, is trying to beat these things at short-term trading. And that's pretty much impossible. I'm going to tell you up front, that's impossible. And I know it myself because I have seen the changes in the stock market since I first got into it. In 1999, I was a day trader, essentially. I bought stocks and I sold them the next day. Now, most of the, you may define day trading as buying and selling before the trading day is over. I held overnight typically, and I was doing these powerful momentum trades in internet stocks. I would watch my level 2 quote and I could see the orders stack up, and I was using charts, looking for periods of consolidation, buying on the breakout, and then these things would go up 30, 40, 50% the next day. I mean, that sounds insane, but we were in a total bubble, and that's what was going on the last year of that bubble, and it was gravy time. Now, that's what I was doing. There were other people, though, that were doing day trading. In fact, one time I went into an office in Miami of a day trading firm, and there were 100 people in there renting terminals, working together with level 2 quotes, day trading. Now, what was interesting was that, and this is going to give you an idea how this high frequency trading actually came into being. But what was interesting is at that time, you could load up a level 2 quote screen and you would see that the bid and ask was broken down into fractions. So you could see basically 1/8 trade, you'd see bids or an ask, say, for a stock at 40 and a quarter, or 40 and an eighth, 40 and a half. And on the day trading screens, you could see resistance often at the half point, at the whole number point, and a lot of short-term trading activity would take place. There are estimates that there were about 60,000 individual day traders spread out across the country at the time in 1999 playing this game of level 2 quotes and watching the bid and ask. Well, After the 2000 market bust, after the top, in a year or two, the New York Stock Exchange arbitrarily made a decision to do away with fractions, fractional pricing, and they went to a decimal system of pennies. That move wiped out the individual day trader because it screwed up the level 2 screen. And this is how the market changed, or part of the evolution in the financial markets. What ended up happening was the individual person, the little man, the day trader, was now blind because they didn't have the information that the fractions gave them. They were now looking at things in pennies, and they couldn't move fast enough anymore. And now program trading began. It started. That's when it really started. Was with the decimal system, because it totally crushed the little man, and now it became a game of the computer program. Well, that trend simply continued by 2005. That's why this chart loaded up here. It was complete, and all the day trading firms across the country essentially shut up shop. They closed down, and the little man, the 60,000 or so people playing this game, they either realized what happened and they stopped, or they wiped themselves out trying to compete with the Wall Street programs. A second thing also happened to contribute to all this, and that was the rise of hedge funds. In 1999, I think there's a fraction of hedge funds now. I think it was actually less than 1,000. Now there's over 5,000 of them. And these hedge funds, because of the way they're ranked, which is on a quarterly basis, they send out quarterly reports to investors, and many of them send out monthly reports. And the largest of them get their funding from Wall Street banks, from the J.P. Morgans, from the Goldman Sachs, from the large individual investors. And what this means is that these hedge funds are ranked on a very short-term basis. What's their return this month? If they don't beat the market this month, Wall Street will take the money away from them and give them to a fund that does it. That means that the hedge funds are essentially hot money that's always chasing the trend of the moment. They do not invest. They do not buy and hold. And they're forced to engage in short-term trading. They're attracted, therefore, to the trading robots, and that's an additional factor in the explosion of all this stuff. And in the end, for the hedge funds, this really means that there's only a few elite trading robot hedge funds every year that are making the most of the money, and the others are getting beaten out by it and having to shut up shop. Then another one will appear with the promise of the next new program, and on and on. And the money is simply flowing into the hot fund of the moment. That's a nutshell what the hedge fund industry actually is about. So this is the structural background behind the rise of program trading that I want you to be aware of. Well, what does it mean for you? Okay, and that's that's the question, right? And you've got two decisions, as I said earlier, and I'm going to repeat this because this is the key takeaway for you. You've got two decisions. You can tell yourself, I can't beat these robots, and the market's manipulated, and if I try, I'm going to lose money, so I must give up. I must surrender. I must go and walk in my broker's office or my investment advisor's office and say to him, I can't beat the market. I'm not fast enough. I'm not smart enough. Here is my money. And then pray that this guy will know what he's doing. That's choice number one. Choice number two is to say, yes, okay, there's manipulation, there's robots. What do I need to do? Okay, here's what you need to do. Do not compete with the robots. Don't do it. That's all. And how do you not compete with the robots? They don't control the stock market in the long run. Yes, they can have an influence on what happens over the next minute, the next second. You cannot compete anymore day trading with these things. Short-term trading, the shorter term, the time frame you use, let me put it to you that way. The shorter your time frame in trading the markets, the more difficult it is going to be to beat the markets because you're competing against these robots. If you use a long time frame, though, then this stuff does not impact you at all. These robots, the hedge funds only look a month out. The robots look a few minutes out. Simple solution. We will look months out to make our investment decisions. And that is something I have been doing over the past couple years. When I started out in the stock market, I was a day trader, a swing trader, and then I moved to swing trading, and then I moved to an intermediate term time frame, and now I'm essentially an investor. I buy stocks with the goal of selling them a year later, and maybe 2 or 3 or 4 or 5 years later. And as a result, I don't really care what happens in the next minute or the next hour, and I don't have to try to beat out these robots. I don't even have to worry about what the robots are doing, and I don't care if they're manipulating the stock market or not, because yes, they can manipulate it, they can gap it up tomorrow, but they are not going to make the stock market do what they want over the next year. They don't even care what happens over the next year. All they care about is today. Well, I invest in a way that I'm investing. I don't trade anymore. All right? That's it. I don't trade. I don't try to beat the robots. I take positions that I can hold. So, okay, how do you do that? That's the true question. You've got to look for 2 things, 3 things, really. You've got to look for markets that are at cheap valuations. Why do you look for markets at cheap valuations? Because if you get in at a good price from a valuation standpoint, then you've got tremendous upside in front of you. And you can use things like the cyclically adjusted PE ratio to identify countries that are priced at a cheap level and therefore have tremendous upside. That's why I invested in Greece and in many of the European markets back in 2012, because they reached ridiculously low valuation levels. And there are sectors now at that point, and even a few individual markets too. And you avoid the markets that are priced at nosebleed, crazy valuations, because those are the markets that are in danger of getting smashed, in a bear market or having some bizarre flash crash type event occur to them. If you're invested in something super, super, super cheap, on a valuation basis, a bargain basement price, well, if a crash were to occur, then you really don't even care, because you're probably not going to really lose that much. And if the market were to fall, your stocks and sectors that you're invested in are likely just to snap right back instantly, just like you saw occur in the United States stock market in 2011. And one of the reasons why the market snapped right back and didn't have a nightmare meltdown despite the activities or the misfires of these robots is because the stock market was not at a super high valuation back then. Today, though, the stock market is a much different story inside the United States. You see, today, the cyclically adjusted PE for the S&P 500 is at 25. You have bubbles in just about all the Dow stocks. You've got stocks like McDonald's, trading with PEs over 30. Most of the Dow stocks have PEs over 20. There is a bubble in the S&P 500 when you look at valuation. Now, I say this, I'm not saying we're in a bear market. In fact, the stock market, it could make new highs. I don't know. But it's highly, highly valued, and therefore, there is a danger that if a flash crash event happened, it could crash because it's at a high valuation and crash and not come right back. That's why, it's just a risk. You can manage that risk in different ways. You can buy puts. You can simply do some selling, or you can avoid the market entirely and invest in other markets. But the more important thing is the other thing. Okay, so how I'm talking to you about how do you invest? How do you do things differently than the trading robots? Okay, we just talked about you buy where valuations are cheap. The second thing is you buy where the trend is turning after a bear market. You see, if you look for something that's already been in a bear market, that's already had a collapse, then the danger of another bear market coming or a crash or some strange event is greatly reduced. And now, after a bear market, you typically get a stage 1 basing phase. During this time, valuations are cheap. The bear market brought valuations down, and now you're combining a look at long-term trends, not what happens today in a market, not what happens this hour, not what happens this minute, but the monthly trends, the monthly trends which display themselves on the 150 and the 200-day moving averages. You allow these moving averages to flatten out. You allow a stage 1 base to take place, and now you accumulate. You're accumulating as the market is shifting and valuations are cheap. And every year there is practically a market like this somewhere. Right now, that market is in the commodity market. Right now, that market is in the metals and mining stocks. And that is why I have been beating the drum on these investments with you since February, and why I have moved my money in there, because these are cheap valuations. It costs approximately $1,200 an ounce to mine a price of gold. The bear market that went on from 2011 to 2013 took the price of gold below production value. It took the price of gold essentially as cheap as it could take it. And now here we are, we are on the verge of starting a new bull market with valuations cheap and the long-term charts giving us the story that we are going to turn up. Let gold let gold break through 1400, and then I will not be the lone voice in the wilderness anymore. Then you will see others surge in. But those early in the game are the ones that always benefit the most in the end. So, program traders, I don't care what you do. I am investing in markets. You don't dare, you don't invest. You don't invest. So, I don't play your game. Play a game you can win. The third thing you must do, though, to play this game is understand market psychology. Because to invest in markets after a bear market, when valuations are cheap, goes contrary to what you're essentially told on the television sets to do. Because bear markets create bearish sentiment among the masses because they sell out and then they give up. And they then turn negative and say, oh, this is a bad market. And the psychology is like, it's a mass group thing. So right now, everyone is negative on gold. Everyone is negative on investing in commodities because the bear market destroyed their mindset and has essentially turned everyone into bears. So in order to do 1 and 2, you've got to understand the psychology of markets. And I talked to you about that yesterday in that video. So, where do you go yourself from here? Recognize the reality. Yes, program trading is a problem. Yes, there is some manipulations in all financial markets, but don't let that scare you. There's no reason for it to scare you, unless you're going to try to J trade and fight these robots. Then it really, if you position yourself so you're actually investing for real by buying into markets that are undervalued and starting new bull markets, none of this stuff really makes any difference. It's a story for the masses in that sense, and it's a story for people who are obsessed with the U.S. stock market and that's all they know, to have an excuse for why they're not doing well in it or an excuse not to invest at all. But if you've got to look away from just being one of these people that only trades the Dow and the S&P 500 and the NASDAQ, or is obsessed with playing the so-called momentum stocks, the Yelps and the Facebooks, which are highly valued. And you can't invest if you do that kind of stuff because those are highly valued stocks, and the market's been in a bull market for 5 years, and you can't invest, So if you just want to play that game, I really can't help you. But if you want to invest for real, and do things where you can buy something and at a cheap price and hold it for years and realize long-term capital gains and sleep well at night, then I suggest that you take advantage of the opening I'm having right now in the Wall Street Window Power Investor Service, because in that I put out reports just about every single week in which I talk about the stocks and specific investments which meet this criteria. Stocks that are cheap, stocks that have tremendous upside potential. They're cheap because they're at a low price to earnings valuation or book value, but also have tremendous growth prospects, are in sectors that are turning up and starting new bull markets. And that's a game I like to play. That's a game they don't talk about on TV. That's a game certainly this Micheal Lewis book won't help you play either, although, it's a fun book to read. I am all about actionable investment information, keeping your pulse on the best opportunities I can find in the entire world, and helping you profit from them as much as possible. And yes, this is a small knit group. That's why I only open it up occasionally. This is the spring opening. I don't know when I'll open it up again. I keep it limited because I communicate with the people on a one-on-one basis in emails, webinars, occasionally, PDF reports, and I even give everyone access to my real portfolio. So when I make a trade, once you join the Power Investor Service, you'll get an email from me immediately after I make a sell or a buy or whatever, telling you what I bought, the number of shares I bought, my plan, everything, full disclosure. No one else does that, but that's because, this is for real, man. So get in, and I'll see you on the other side.